Some questions about inflation and the value of the dollar, plus the economic impact of President Trump's health. I'm Erik Brenner. Join me now for Your Wealth Health. Hello and welcome to Your Wealth Health. I'm Erik Brenner, owner and founder of Hilltop Wealth Solutions. If you're watching us on Facebook, please share us with someone who could use this information. And thanks for watching us on yourwealthhealth.com. Joining me today are Bill Davis, a private wealth advisor for Hilltop. He is in the studio with me, but we are continuing to practice social distancing. And our Director of Wealth Management, Matt Aurenz, joins us from his home in Valparaiso. We begin today with the recent news that President Donald Trump has COVID-19. When it was first reported, the stock market dropped significantly, but then it recovered. And although it finished down, it wasn't really as bad as many thought, or it might have been. The S&P has lost less than 1% on the first day of the news and has been pretty steady since then. So, Bill, how do we think about this? What do we think the stock market's going to do based on this news?
Well, Erik, the stock market's been very resilient. I can take us back a little bit further. We were watching the trading ranges back in the summer, and we were concerned about COVID spiked, and the market went higher. We were concerned about shutdowns. We shut down California, Arizona, Texas, and Florida. The market went higher. Now we're experiencing the spread of the virus to the White House, and the market, although like you said, in one day pulled back a little bit, but since then, in the next couple of trading days, the market had some pretty significant strength. So this is demonstrating to us that this market just has a ton of resiliency.
So, Matt, we've talked on this show about the Fed and the Treasury and the things that they have done, over the last many months. And, this maybe shows that what the Fed and Treasury are doing is kind of the market's looking at more importance there than maybe some of these other kind of things that's happened.
I think you're exactly right, Erik. I think that's exactly what it's showing is that the market is responding more to Fed policy as opposed to the nuances of just day-to-day life and random variables that can influence the market when it comes to COVID. So the Fed really has a lot more control, controlling monetary policy, stimulus, interest rate environments, inflation, those types of things. So we're seeing those stronger pressures really control the market or influence the markets much more than just the typical day-to-day stuff as it results to COVID-19.
And do we think, Bill, with this news, do we think that it could potentially delay some of the opening or, how that might affect just economically?
Yeah, that's really yet to be determined. But the things that I'm reading about and listening to as it relates to these situations is that the economy is not expanding at the rate that we would like. In fact, we even see some slowing of the economy. And so that's a little bit concerning to me in the sense that certain industries just can't reopen without some kind of medical treatments or vaccines that's going to allow people to have some confidence to be able to go out and do things like travel. And, travel and leisure is an example of an area that's just been decimated. So the fact that the economy is kind of slowing slightly, there's still some robust areas of the economy, but especially the stay-at-home trade and any of these internet-based companies or gaming, a lot of those things are doing real well. But we'd like to see a much broader scope of expansion in the economy.
Yeah, so Matt, ultimately when people are investing, which is what we talk about here is markets, savings, investing, retirement planning, we just want to encourage people, again, not have your investment strategy based on just full emotion, and think about it kind of through it and long term.
Exactly. I think the other thing it points out, Erik, that we've just stressed before is the timing of the market is extremely difficult. If you were playing this game, to Bill's point earlier, and said people are starting to shut down, and you say, hey, I better sell everything. All these states are shutting down. You would have missed a massive rally. If you would have said, hey, let's sell everything because the president now has COVID, you would have missed a nice uptick. So it really becomes very complex trying to figure out the timing of this market. Some of this stuff is a little bit mind-boggling, but it just stresses the point of stay invested, stick to your goals, continue to address your portfolio and your risk, but maybe add or remove things to your portfolio, but don't just make massive decisions based on emotions.
Yeah, so with President Trump's situation, that really has intensified the spotlight on other issues impacting the economy, including the news that another relief package may be on the way. We want to spend some time on some of those economic issues that have raised questions. We're talking about inflation, deflation, and the value of the dollar. A couple weeks ago, we discussed the Fed's decision to keep interest rates really near zero for the next few years and the impact that it could have on our economy and investment decisions. And the Fed has also addressed inflation, citing a need for some inflation, but definitely not too much. Inflation is the rate at which prices of goods and services rises. And why is a little inflation good, but not too much? So why is that, Bill? Why do we want a little inflation but not too much?
Well, I think what people need to understand is, inflation is going to be different across different sectors. Give you an example. It's really a supply and demand issue. Look at the stay-at-home situation with all the DIYers, all the do-it-yourselfers, and in that situation, there's a significant need for lumber, and building equipment and things like that. So here you have an inflated cost for that specific sector of the industry, and so we, I think also of low inflation stimulates commercial growth. So if businesses can believe in a low inflation going forward, they can make capital expenditures to expand their businesses now, understanding that they're going to be in a low inflationary period for some time to come.
Thanks, Bill. And so, Matt, there has been some concern with all this money we've dumped into the system, with the relief because of the pandemic, could cause this inflation, especially if we get a vaccine. The economy responds quickly. But anyway, what are your thoughts as it relates to that? Do we still have concerns with that?
I think it's always a concern. I think we had the same concern the last time the Fed and the government stepped in with stimulus back in the 07 to 09. We were expecting some pretty significant inflation numbers and just didn't happen coming out of that recession. In fact, the 10-year moving average for inflation is only about 1.7, 1.75 right now, which is exceptionally low long term. So I think that there's always that risk of, yes, inflation could go up. And I think to Bill's point, we'll probably see it in specific areas. The do-it-yourselfers obviously are causing housing goods and prices to go up, but we are seeing things like gasoline, what you're paying at the pump, go down because people aren't traveling as much. There's a massive surplus. So coming out of this, I think we'll probably see inflation be risk factors or those areas with hiccups in their supply chain. So the demand for something that's really strong, but somebody who's not able to produce it at a rapid rate is going to create inflationary risks in certain areas. But I think as a whole, the Fed is really paying attention to that, which is why they have rates low. They're going to try to raise rates really slow so that they don't overinflate and create a massive inflationary risk long term.
Great. And Matt, we have a graphic here, and quickly I wanted you to just explain this graphic. There's a lot going on as it relates to interest rates and rate of returns, but give our audience kind of a sense of what we wanted to convey on this graphic.
Well, I think what we want to convey here is the fact that, interest rates and just inflation in general, but interest rates when it comes to fixed income is an inverse relationship. So as interest rates rise, bond prices drop. So if bond prices go up, it's because interest rates are usually dropping. And so this graph just kind of shows the risks that we're seeing going forward in portfolios when it comes to interest rate movement. So theoretically, these are just flatline prices of what would happen. And so if you took a look at if rates went up by 1% on the 5 to 10 year treasury, we would expect bond prices in that asset class to drop by about 4.5%. If they go up 200 basis points, which is equivalent to 2%, we would see about a 9.5% drop. And so as you see here, there's going to be different risk factors based on whether it's corporate credit, longer duration, those types of things. But this graphic really kind of dictates, we do see concerns more in the fixed income market over the next 10 years, 12 years, coming out of this low interest rate environment, because rates can't get any lower. So as rates increase, we will see the bond prices drop, which again forces people to look elsewhere for investment returns. So you really have to have an investment game plan tied to long-term goals.
So really that would definitely concern those, or should concern those, that are kind of ultra conservative in their portfolios with those fixed type investments.
That's exactly right. Those people who are very conservative and don't want market risk really have to figure out, well, there's going to be some trade-off if they don't want market risk.
Yep, great. Thanks, Matt. So we talk a lot about the Fed, which is short for the Federal Reserve, and we wonder if people really understand what the Fed is and does. When we come back on Your Wealth Health, a little lesson on the Federal Reserve, and we'll discuss the current value of the dollar. Stay with us.
I switched to Home Comfort Experts.
We switched to Home Comfort Experts.
I switched.
We switched.
I switched to Home Comfort Experts.
To keep my family safe.
For their expertise.
For efficiency.
Because I trust them.
We're comfortable.
I'm comfortable. We switched to Home Comfort Experts, and I couldn't be happier.
It's time for your annual furnace tune-up. Call now and take advantage of our $89 20-point precision tune-up. 574-255-4600.
Welcome back to Your Wealth Health. I'm Erik Brenner, owner of Hilltop Wealth Solutions, and I'm joined today by private wealth advisor Bill Davis and our director of wealth management, Matt Aurenz. The Fed, as we call it, has become very important when it comes to the economic policy, and we thought we should provide a little more information about it. So it was founded by Congress in 1913 to provide really the nation with a safer, more flexible, and more stable monetary and financial system. So let's talk about the Fed and kind of, what their roles are, Bill, in, helping our economy and making sure things stay on kind of level ground, if you will.
Yeah, Eric, we wanted to differentiate. I think people get a little confused with all of the infusion of capital in the markets. And so, there's fiscal policy that's handled by Washington and the Senate and the Congress. And then there's monetary policy that's handled by the Federal Reserve. So, their responsibility is to help us manage interest rates that affect lending, overnight lending. So we have an overnight lending rate that's down to basically zero, and they're also responsible for managing the inflation, monitoring inflation, and trying to push some inflation into the system, which is a little bit easier than the opposite if we were experiencing a deflation like Japan has for the last 20 years. And so I think that, coming out of the 08-09 situation, they infused a lot of monetary stimulus. But I think what they've learned since then is to infuse a lot more capital, which is what they've done in this pandemic situation. So that's the stimulus has just been unprecedented and continues through fiscal policy of infusion of capital into the fixed income markets.
And there oftentimes, we hear the Fed chairman, right? So Fed Chairman Powell right now is, who's appointed by the president. There's been other past ones on Janet Yellen, Bernanke, Greenspan. But we wanted to just point out here that there's really 12. There's regions all around the country, Matt, and the members of the Fed have a lot of experience, and a lot of them from 08-09 when we were in the financial crisis, as to what they did there, what worked and didn't work, and how they approached this pandemic, and how they thought that they should help to stabilize the economy.
You're right. They served around 14 years or so. So a lot of them were there in the last market collapse that we had, or recession that we had. And I think they learned a lot on that first time. I think they learned that they really can't just sit around and do nothing or wait for something to happen. Obviously, this time they were much more swift in their response to market volatility and what was going on in the economy. This time, obviously, was much different as a pandemic compared to a financial collapse. But I think they learned things, and I also think that they learned different ways to stimulate the economy with monetary easing. So it wasn't, in the past we heard that Q1, Q2, Q3. This time they're infusing capital into the treasuries. They're infusing capital into corporate bonds and equities. They're kind of doing a much broader based approach, trying out some different things, and it seems to be helping. But I do believe that their terms and their tenure has definitely helped with a much smoother transition this time than we experienced in 07 to 09.
So, we discussed the role in trying to control inflation, but what about deflation, Bill? Should we be concerned about deflation?
I just can't see it, Eric. I just can't see us getting into a situation like I mentioned Japan got into, and prices of goods just plummeted. We have an economy here in the U.S. that is 70% of our GDP is driven by consumer spending, and when you tend to get deflation is when people back away from spending, and I think we're going to come out of this pandemic with quite a pent-up demand for consumer goods and spending. Just think about retail. Nobody's going to the retail stores at this point in time. Most everything's online buying, and I think there's a pent-up demand for people to want to get out into the stores and look and feel and touch the commodities that they want to buy, and so I think the risk of deflation is very minimal. And it's even difficult, as you can see, them driving inflation. I did want to add one thing to Matt's point, though, about recent activity in monetary policy, and that is the effect that the Fed has on the reserve rate at banks. So in March of this year, they eliminated the reserve, and what that does, that allows banks to lend more, and so we see things like mortgage applications, refinance applications at an all-time high. Had a discussion with a banker yesterday that said they increased their interest rate above the norm just to slow down the applications that they're receiving, and that's right here in our region. So the fact that they took away that reserve from all the banks is now stimulating even more lending.
Yeah, this lending thing, I just recently had a client that did a refinance and got from an institution 2.25%, and no closing costs, no appraisal fees, no closing costs, as long as they were there for 2 years. So the rates are just unbelievably low. So Matt, what if someone's really concerned about this, whether it's inflation or deflation, what do they need to think about as it relates to their portfolio and their strategy?
I think strategy-wise, they just have to look at, if inflation is a big concern, what traditionally helps you in a rising rate economy. So as inflation goes up, what are some things that you can employ in your portfolio to help hedge against it? So oftentimes you hear about things like gold, which has had a nice rally, but it's a very volatile commodity. You have other commodities, oil, pork bellies, all that kind of stuff. Commodities is a big thing. As goods go up, those go up with it, and you can make some money in your portfolio. In the fixed income world, you hear oftentimes about TIPS, which are just tax inflation protected securities. So those help those rates go up again as inflation goes up. And the number one thing I think for most people is equity markets. So the stock market itself, as companies are making more. You would view it as a way of, if inflation goes up, it's because cost of goods are going up, which means that companies are now selling things at a higher profit or making more of a profit margin because they're doing well. So you would expect their earnings quarterly to come out and look good, and you would expect their share prices to go up. So the stock market itself is probably one of the best ways to hedge against inflation. And I think that's why the Fed really prefers, when rates are at low, zero or near zero, is a way to push people into the stock market to help hedge against that. So those are things that we see often. But again, it's not like you just move your portfolio there and just let it go. And you have to know how much to put in, and you have to know where to put it. And so that's really where you begin the discussion with your advisor.
Yeah, great. Thanks, Matt. So you may have questions about inflation, deflation, how it fits into your overall situation, what you should do. We're here to answer those questions for you. We offer up a free 30-minute phone call with one of our advisors to really determine, more about what you want to accomplish, whether you're on track, and whether or not we can help. So with all the different questions about our economy, what should you be doing to get the most out of your situation? We're going to have some answers when we come back on Your Wealth Health.
I cannot work, do e-learning, and keep this house clean.
You should try Kay's Way. We heard you were dirty, so we came in a hurry. We can't help you with the e-learning, but we can help you with the cleaning. Try Kay's Way.
Sam's Car Wash, corner of State Road 23 and Fur Road in Granger.
Welcome back to Your Wealth Health. I'm Erik Brenner, along with Bill Davis and Matt Aurenz, and we've been talking about the economy, inflation, deflation. And so, Bill, I wanted to touch briefly about, people bring up with us, clients bring up concerns about the value of the dollar. So I know we've got this graphic here that we just wanted to touch on.
Yeah, so, the value of the dollar's depreciated slightly this year. But it's still very strong. I mean, it's the strongest currency in the world, and so people migrate to buy the U.S. dollar versus other currency. And so if it does go down in value, we could see some increased cost of imports, and because we import so much, that could be an issue. But for the viewers, I would be thinking about looking at your international exposure, because it could have a negative effect on international investments. So that would be where you'd want to consult with your advisor to determine an appropriate allocation to international equities.
So, we think it's important to keep yourself up to date on economic trends, but we also believe it's really important here at Hilltop to discuss yourself, how you manage questions, figure out what's best for you. So, Matt, we just wanted to point out some really important things as people are thinking about, the goals they have and making sure they're making the best decisions for themselves.
Yeah, you're exactly right, Erik. I think the point of all of this is there's gonna be ongoing uncertainty in the economy for years to come. I mean, every graph that we look at over the last, 50, 60 years has a lot of different variables coming in, whether it be wars, recessions, inflation, tax changes. There's always something. And so I think it's really imperative that you just readdress your goals on a constant basis. You're looking at your investment strategy on a regular basis, and don't be too quick to make decisions or move, specifically, emotionally. And just again, work with your advisor on a regular basis to address these goals. This is something that is not just a set it and forget about it type of strategy. You really have to pay attention to it regularly, and you just have to make sure that what you're doing makes sense, that it's not an emotionally driven decision.
And Bill, Matt, you and myself, we've been doing this a long time, working with individuals, kind of helping them along their financial journey, and just this emotional decision making it just doesn't work out financially, in the long term, does it?
Yeah, and I don't think I've ever experienced in my 24 years, more indecisiveness and more decisions that are needed to be made based on tax law changes, what's going on in Washington. Now we could be looking at an administrative change, and I think it's more important than ever that you have professional advice to help you sort through all of the decisions.
And we at Hilltop here, we're, fiduciary financial advisors. So we wanted to point out really, what does that mean? So you have a choice on obviously who you work with, and you can also put into that choice how that advisor works. Do they work based on commissions? Are they independent? Are they a fiduciary, which means that they must act in the best interest of their clients each day? It's not based on commissions. Do they have experience with helping people down in their financial journey? How many people have they actually helped guide them through retirement? Matt, all of these things are really important because it's their money, it's their future. And again, a lot of times what we do is help people avoid maybe mistakes in their financial life.
You're right, Eric. I think it's the costly mistakes. It's the unnecessary fees that people are paying. It's the getting locked into investments that they don't understand. It's not planning appropriately for a goal. It's just, let's just invest some money, but we really don't have an idea of what we're investing for and what type of rate of return we need or the risk tolerance that we have. They don't fully understand the relationship with those advisors. Are they working with my CPAs? Are they working with my attorneys and my insurance agents? All of that above. You really need somebody to kind of quarterback that financial picture for you. It's to Bill's point. We don't see any more things. There's always something that constantly surprises us. That's moving in the Fed and the government and taxes, and you really just need somebody to help you with that.
And the tax point, we've pointed out here that we are in the lowest tax rates that we've been in for 40 years. And we do think that taxes probably will go up. There's a high likelihood they're going to go up. So now is the time as it relates to making sure that you're taking advantage of all those strategies. Next week on Your Wealth Health, we're going to answer questions about Medicare enrollment, which begins October 15th. And we've already had a lot of questions from our clients and others. We're going to have Sherry Kramer join us. She is an expert on Medicare with many years of experience, and we're going to help you manage Medicare next week on the show. So, and hopefully answer some of your questions as well. We're out of time for now. For Bill Davis, Matt Aurenz, and myself and the entire Hilltop team, we will see you next week. And thanks for joining us. Take care.